Let me introduce the current vice chair at Brookfield Asset Management, former governor of the Bank of England, special envoy to the United Nations, Mark Carney. Mark, it's really, really good to see you. I'm sitting in a room in New York where I would love to be with you and actually having this conversation, but this is the world we're living in.
It is the world we're living in, and this is the next best thing, Jason. Thanks for having me on.
Well, it's great to see you. And, it's interesting. You and I caught up toward the end of last year when you got this interesting new job. Now you're here to tell us a little bit more about it. It's a big new job. It's a bold new initiative. Tell us what you're up to.
Yeah, well, we've talked in the past, and back when I was a central banker, I focused on the risks related to climate change. You mentioned the UN role, the special envoy role. There, we're putting in place the financial architecture so that every financial decision has the information, the tools, and the market so they can take climate change into account. The Brookfield role is really putting all those words and those initiatives into action. It is about setting up an impact strategy, which takes companies and assets that aren't aligned to Paris, that can decarbonize, and putting them on that path, catalyzing that decarbonization, and in the process, making industry-leading financial returns. So it's exciting, and it's about the mainstreaming of this necessary transition to net zero.
And it's about putting actual capital to work. So tell me about this fund, because you've put some meat on the bone, as it were, about how this is going to look, how it's going to be deployed. Help me understand how that works and sort of the scope and scale of what you're after.
Yeah, well, a couple of those S words are pretty important. So let's start with scope. It's a global focus. It is scale. This is going to be substantially larger than any impact fund to date. It is going to have a singular focus. As you know, there's a lot of good in the impact space, a lot of innovation that's been there, but in most cases, impact funds have multi-purposes. They're doing a variety of good things and achieving various objectives. We've got one objective, which is to put assets and companies on a path to net zero, to be part of the climate transition, in fact, to accelerate the climate transition. And so with the global scope, with the operating expertise and the reach of Brookfield, we're going to go out and do that and look to deliver those returns. So it's a double bottom line. And I guess the key thing and why we wanted to have it as an impact fund is so that we have the same discipline in achieving that environmental objective, reducing the amount of carbon and greenhouse gases that these companies and assets are emitting, making them part of the solution to climate change, not part of the problem. Have that same focus and commitment and clarity, transparency, as we do to the financial returns that we deliver.
Well, and I want to talk about sort of some of these intersections, because you've lived at a number of them over the course of your career and currently do as well. But I want to spend another minute, if we can, on Brookfield, because there is this question, when someone like you, and we talked about this back last year, when someone like you, quote unquote, leaves a post like you left at the Bank of England, there's all sorts of speculation. Where's he going to go? What's he going to do? And you sort of vote with your feet in many ways. Help me understand the Brookfield story here and why that was appealing.
Yeah, well, as I said a moment ago, Jason, I wanted to put words into action. I believe that this is it's climate change is the biggest risk to the world. But when you turn it around, if you're part of the solution, it makes it the biggest commercial opportunity in the world. In effect, we're going to rewire, so to speak, the entire global economy consistent with net zero. And I wanted to be at a place that could play a leading role, in fact, in many respects, a defining role in that. Now, it happens to be the case that I have known Bruce Flatt, CEO of Brookfield, and many of the senior partners of Brookfield for longer than I'd care to admit, but I will admit to more than a quarter century. I've seen what they have done with the firm, transforming it from into one of the world's leading alternative asset managers, shifting from black to through the spectrum, the underlying assets towards green, not all the way to green, but towards green, and in the process developing this enormous expertise. Not just in renewables, but really in decarbonization, understanding energy systems, understanding business transformation. I mean, this Brookfield is an entity that operates, doesn't own, it does own, but it also operates 20 gigawatts of renewable power across hydro, wind, solar, across 4 continents, and then has the equivalent, in fact, more than the equivalent of in their development pipeline. So track record, expertise, the people, and that ability to operate at scale, at global scope, and to focus on transformation, that all lined up for me. I guess the last thing is just an enthusiasm within the organization to accelerate what needs to be done.
Well, and it's interesting you mentioned enthusiasm, because as I was getting ready for this, Mark, I consulted, people around me and around this industry about you. I was asking questions about you. And it's interesting, you are framed as someone said to me, someone who has had more than any other person a singular impact on bringing this issue of the climate crisis to the financial markets. And I guess I do wonder, now that I've got you in the hot seat, why? Why did you take this on? What sort of generated that enthusiasm for you?
Yeah, it's an interesting question. I mean, it's kind of you to say that. Lots of others have played these roles, and we all need to play this role. To some extent, there was, I'm not sure I can point to a specific epiphany, but a gradual realization after I got to the Bank of England. I shifted from thinking that others were I always knew this was a major issue, but you sort of think, well, that's an issue for others. Others are going to take care of it. Climate policy, the responsibility of governments or innovators to come up with the technologies. And then realizing that it just wasn't moving fast enough, and looking forward, as was my then responsibility as governor of the Bank of England, looking forward and saying, wait a minute, there's massive financial risk on the horizon. And it's going to end up being closer than we think in terms of not just the physical manifestations of climate change, which quite frankly were easy to see. The Bank of England, as you know, and many don't, oversees the world's 4th largest insurance industry. So we had direct sight on these physical risks. But really what we're seeing is the prospect of enormous stranded assets, potentially, if we transition, if we succeed. Success is failure for some companies in this world on climate change. Enormous stranded assets if we succeed. But wait a minute, if we don't, then the world's heading to 3 or 4 degrees. And the financial sector was just not oriented. So that's really was the crystallization for me. There's a limit, obviously, and rightly so, what you can do as a central banker for that. A lot of the focus then was on disclosure and gaming out these risks for banks and insurers and others. But I, took the view once I was going to move to the private sector when my time was up at the Bank of England. Wait a minute, I want to work to help catalyze this. And I have long felt that if we are going to address this issue, it requires the mainstreaming of climate change and obviously the leadership of the private sector. And now it's very clear this is what society wants. It's beginning to mainstream. And the last point I'll make, not the last point of this interview, but the last point of this answer, is that there's an opportunity with this fund for us to help define what good is, what real transition is, a rigor around actually that decarbonization, a rigor around not just starting at the end state or, with green, but taking assets that are brown or beige or even olive and shifting them to green over the life of the fund.
I mean, it's interesting. We did a couple polls ahead of this conversation, and one of them was around investing sort of around the issue of climate change, and this notion of investing in climate change is smart money. Hard agree, got 66%, not convinced, still getting 22%. But I do wonder, that 66%, I'm not sure we would have gotten that 66 2, 5, 10 years ago. It feels like there has been something of a shift and something of an acceleration even in the past year or two.
I without question, at least from my perspective, there's been an enormous acceleration. This has moved from, as an issue, if I put it, let's be safe and let's go back 10 years. It was more a corporate social responsibility issue, a CSR issue. Now it's a C-suite issue. It's an absolutely strategic issue for virtually every company. There's some who are already robust to the transition, but virtually everyone else is going to have to make changes or is in the process of realizing the scope of changes they need to make. And that means it's a determinant of value. It's not just a determinant of risk, but it's a determinant of real value creation, which is, obviously I'm in the hard agree camp. And there's a variety of ways to look at this, and this really does span the whole investing spectrum. So about 70%, just under 3/4 of global emissions, you can ultimately trace back to the energy sector. Okay, so it's not just power generation, but it's energy for transportation, energy for buildings, and energy for industrial processes. Much of that is ultimately going to be that stripping out those emissions is going to involve electrification and obviously turning electricity green, turning electricity. And so there's an enormous opportunity there, measured, 3.5 trillion of investment needed over the course of the next three decades per annum, 3.5 per annum, so 100 trillion probably in total. So huge opportunity in and around that. And most of that is either commercial or just coming into being commercial. So huge capital opportunity to catalyze that, and that plays to all of Brookfield's strengths. Then there are those emerging technologies that are on the cusp, and really over the life of the strategy we're talking about, will come into economics. And think hydrogen and the associated systems around there, direct air capture, carbon capture, other aspects. And then there's the essential breakthrough technologies, to use Bill Gates's term, breakthrough energy technologies that need to happen for us ultimately to get to net zero, which is more VC or growth equity. So it does cut across the whole range. Last point, but also because of the scale of the change, as I said earlier, you're rewiring the economy. So it's not just about those power assets, it's about the energy services, it's about how you organize data centers, it's about how you organize district HVAC for buildings, it's whether our homes or neighborhoods become load bearing, or how we manage load within that. Huge necessary steps that need to be taken, and with all of them, a great value creation if you're in that hard agreed camp and you're looking for it.
And so, and we're going to spend a little bit more time talking about the commercial side, but before we get to that, we have to take a beat, I think, on the political side, because it feels like 2020 was also a year where the political winds shifted maybe in a positive way, and one would argue, sitting in the United States as I am, they have shifted dramatically from a political perspective here in America with a new administration coming in. What did you see that was the most important in terms of the political and governmental policy leadership happening that made you more, if not optimistic, maybe less pessimistic? I don't know how you would characterize.
Yeah, no, I would say more optimistic without question. But one comment I make, and been in and around policymaking for a couple of decades, and very often, I mean, politics follows the people, and I think this is a classic case. You had a increasing hardening of view amongst people of all generations, but very importantly, the younger generations, but really of all generations, that we've got to deal with this. This is the situation is getting too severe. The object in the mirror is closer than we think, and we've got to tackle climate change. And that ended up, so that was there roughly this time last year, just before we moved into full pandemic. And it was reinforced by the pandemic, without question, reinforced the lessons of the importance of resilience. You can't self-isolate from climate change, the importance of listening to science, and the importance of both solidarity and sustainability. And a recognition, I think, is in parallel that the market is needed to solve these issues. But the great thing is that once society decides what it wants, and very importantly, and this is a point that Secretary Yellen and I made in a paper late last year, which is if policy is relatively predictable, path or price of carbon, or clear regulations on things like internal combustion engines or hydrogen and others, then the genius of the market is to pull forward the adjustment and smooth that adjustment. Because the market knows where. And I think that's part of the reason is that we're in a position now where there's very high degree of confidence, certainly about where people want to go. We want to be sustainable. We need to get to net zero, and more confidence that regulation eventually is going to fill in consistent with that. We have some tangible examples, and therefore the market moves. Now, can I make an adjacent point to this, which I think is quite important in terms of what it means for the financial sector? Because what we've been talking about thus far, rightly so, is really focusing in on what companies are going to do, company focus on net zero and the adjustments accordingly. Well, That's also being played back to financial institutions as well. It's like, wait a minute, there's a bit of a chicken and egg. Can you get to net zero as a financial institution if companies aren't moving? But as companies start to move, all of us in the financial sector are being asked, what's your plan? What's your stance on net zero? And that's something we've looked hard at Brookfield. To say, spend a moment on that, which is Brookfield's in a position today where we are net zero today. Brookfield is net zero, and that's not net zero just in our operations, the buildings we have and if we ever take flights again, when we take flights again, and the hotels and things like that, and the paper, et cetera, but across a 575 billion asset portfolio. And the reason we're net zero is we have this enormous renewables business that we've built up, and all the avoided emissions that come with that. Now, two things to add to that, though. First, just because we're net zero doesn't mean we're everything's green. We have assets that span the spectrum, and we have a commitment that we will manage those assets and work to decarbonize those assets over time, very transparently, and provide the information that the market needs in order to judge that. So again, it's climate change, so we all have to work to take carbon out. But the other element of the strategy is very much what we were talking about earlier. Okay, we're net zero. We think actually we're net zero on a scope 3 basis, which is remarkable, but we still will move with the other assets. And then we've got this strategy on the transition side to catalyze and accelerate the transition for others. And we think that's the type of commitment that makes sense in this environment, and we expect that many others will come in behind it.
And so, on that exact point, is that same societal pressure? Does that translate to investment firms and their ultimate customers? I mean, do the pension funds, do endowments, do sovereign funds, are they applying more pressure to financial institutions at this point? And how much has that changed?
Yeah, that is shifting. That is definitely part of the shift. So, and I'll give you a couple examples of that. There is a group called the Net Zero Asset Owners Alliance. Exactly the types of institutions you're describing, spread around the world, U.S., Europe, Asia, 5 trillion of assets that they own. They own the assets, and they're committed to net zero. And included in that is a 25% plus decarbonization objective for 2025. And so when you think about these, and these are institutions that own a lot of hard assets, so they can't, and very big portfolios, they can't spin on a dime. So they're expecting management down of those assets. That's the first thing. We're seeing the asset managers move as well, with some prominent examples in recent weeks, but also a group that's formally committed to net zero that totals $9 trillion outside of the announcement of BlackRock that we saw a couple of weeks ago. We will see more of those, I'm confident, over the course of this year, and including, I believe, a number of the banks to look towards their so-called finance portfolios and how they will manage them over time. Because in the end, society's lining up with this objective. We've got 130 countries and counting who are committed to net zero. And you're really left with three options as an entity. You're either have a path and a plan for net zero, or you're winding down your business over the course of the next 10, 15 years because you don't think you can get there. And your third option is the least attractive, which is you somehow think you're separate from society and the rules don't apply. And it's a free world. You choose your option, but I think the first is in most cases the most profitable.
Well, it's interesting to think about that, Mark, in some ways, because maybe better than anyone how important messaging is. When you were the governor of Bank of England, you knew that every word was measured, every phrase, every choice that you made. How much of this, and maybe this is a little bit of a silly question, but I'm a journalist, you'll have to forgive me. Like, how much, there's a certain elegance in net zero, right? There's a certain that you can sort of lock onto it in some ways that maybe isn't as easy to do with, well, we need to, keep the warming of the planet within this range of percentage degrees.
Yeah, Jason, you're absolutely right. You're absolutely right. There's a clarity of it. And, the reality is the carbon budgets, that's what goes with net zero, as you know. So we only have a limited amount of additional carbon greenhouse gas that we can put in the atmosphere, or else we'll end up at higher temperatures. But actually, we need whatever temperature we want to stabilize the climate at. We have to get to net zero. It's climate. Ultimately, climate change and degree of warming is a function of the stock of carbon and other greenhouse gases in the atmosphere. So we eventually have to stop producing it, or else it's just going to keep going up. And so, very simple. We've got to get to net zero. Countries and society have chosen where we want to go, which is something less than 2 degrees, ideally 1.5 degrees, which still will result in quite substantial climate change. And then you work backwards from that, and how do you get there? So you're absolutely right. And that's part of what's changed. The knowledge was there 10 years ago, but the language was in terms of sustainability, huge risks. There was a sort of hair shirt element, if I can say that, to a number of the conversations around climate change and the scale of the risks, and very little about the elements of the opportunity. And that's part of what shifted. Candidly, what's also happened during that period of time is, and full power to the innovators and the engineers and entrepreneurs who have shifted the economics of a number of these technologies. And last point, given people real confidence that, well, 30% plus of the emissions are still quite uneconomic, let's put it that way, to reduce, in some cases markedly so. With the spotlight of the market, the spotlight of entrepreneurs on getting that done, there's confidence that people will do it and will make a lot of money and should make a lot of money in the process.
Well, to that point, I want to bring in one audience question which speaks to that exact issue. This is a question from Marcelo Lando. He says, economic incentives, as you were mentioning, seem critical to achieving the Paris Agreement. We're going to talk a little bit about Paris versus Glasgow and all that good stuff. Other than in the European Union and the UK, it does not seem that there will be a meaningful carbon price that would align incentives. Are there any other ways in which economic incentives might be more clearly aligned with the goals of the Paris Agreement?
Yeah. Well, Marcelo, it's a good question. And I understand the thrust of it. I'd say a couple of things. One is that just like with getting to net zero, there's not one technology or one solution to get to net zero, nor with climate policy is there one perfect climate policy. There isn't a magical carbon price at which everything would reorganize itself in the most efficient way to get there. Carbon price is important, and if you can put it in, it is important. And I would add to that list, you have examples, for example, in Canada, where the legislative price is going to 170 Canadian in 2030, which is a big number and will encourage big changes as a consequence. But what the other policies that can supplement are policies such as, for example, the internal combustion vehicle moratorium I mentioned, that being in place 2030. Well, that tells me as a vehicle, if I were a vehicle manufacturer, I've got 1.5 model cycles before that. Okay, I'm going to make the kind of dramatic decisions that a GM has just done. It's got an important European business, but it's got a global business, but it sees where the world is going. It's been investing in technologies, it's making a judgment there. It tells me if I want to invest in EV charging, that actually there's going to be a return to that in the relatively, so that sort of regulatory fiat, those types of decisions. Very importantly for technologies, for example, around hydrogen for transportation. That'll be my last example, but I think it's a good one. Regulations around fuel blends in the future, so certain fuel blends for maritime transport, for example. What that does is it gives you greater demand certainty for those who are producing essential technology, mechanical technologies such as electrolyzers for hydrogen, and actually starts to shift the economics of that and certainly the investment in that, as well as it says to somebody who's looking at, for example, energy infrastructure, well, the value of energy pipe and distribution facilities potentially has this big upside option value that could well be realized on hydrogen, repurposing of that, and you have to do some investment for that, but it shows you that. So that type of regulation, which gives greater demand certainty in the future, is incredibly valuable to drive the type of change today that starts to shift the economics and makes it just easier to roll it out at that point.
Right. So let me ask you, before we get too far away from Paris, I mean, obviously that was a massive agreement, widely hailed. So many people came together. You were obviously, right in the midst of that in a very important way. Glasgow, we're looking ahead to this year. What's the legacy of Paris? What's the expectation for Glasgow?
Yeah, I think I'm going to not do Paris justice. It was a landmark agreement, and full credit to the French and Secretary Carney and others who were instrumental in achieving it. But if I were to say two things, first, they changed the architecture in this approach of voluntary commitments, so-called nationally determined country carbon plans. First point. So that made it easier to, and there was a sort of ramping effect to increase ambition, but it didn't have this sort of, it didn't have the old architecture of Kyoto, which was a supposedly binding treaty, which didn't turn out to be binding. So that was an innovation. The second thing, I think it was incredibly valuable that they set the objective, the sub 2 degree objective, and then were objective, in terms of adding up all the country plans and saying, well, wait a minute, that doesn't add up to the objective. It adds up to 2.8 degrees on our best estimate. And that sort of transparency is quite important because it does a couple of things. One, it reinforced this carbon budget and net zero point dynamically. It showed that we all needed to do more, even if we lived up to what we said we were going to do, countries have said we're going to do. And I think the thing that shifts with, we hope, one of the things that shifts with Glasgow is Paris started the initiative on subnational governments and the private sector. And because I'm on this network, but I mean, Mike Bloomberg played an incredibly important role, particularly in the first one, the subnational governments with cities and the cities initiatives. Now it's the coming of age of those initiatives with Glasgow. It's global net zero, everybody in, expectation to go back to what we've been talking about for companies and financial institutions is, what's your plan? What's your objective? Not just 2050, what's your near term objective and how are you going to start getting there? Are you in or out? And what we're seeing, to the credit of major companies around the world, major financial institutions, is more and more saying they're in, which gets this reinforcing process in place.
And so, when you think about this sort of intersection of policy and business and investment, I'll say it out loud. When Bruce Flatt, brings you aboard, I am sure part of what he's thinking about is you can call Secretary Yellen, you can call any number of central bankers, any number of high-level government officials. You have a rapport with them, and you also understand their jobs. So how does that play out? And as you look at what is in front of policymakers at this point, what advice do you give them?
To get well, it's interesting. I think my main value add at Brookfield is really about this transition and how it cascades from the financial. What role do we play as Brookfield in delivering this transition, and what are the expectations of Brookfield's investors, its partners, such as those major asset owners, principally those major assets? What are their expectations? What do they need to deliver? What do their citizens ultimately deliver? And how do we get there using our expertise? So it's actually more, it's really that as opposed to looking on the policy side.
Interesting.
Now, that said, it's lonely being a policymaker. I'm certainly lonely at the Bank of England. And you do reach out to people from time to time and get perspective on things. I think my perspectives are more sought on areas that actually aren't directly relevant for Brookfield. I mean, we all care about financial stability and we care about monetary policy and fiscal policy, but it's not, Brookfield isn't a macro investor in that regard. And so that's that, to be honest, more of my discussions are in and around that. And then obviously I'm very active with a number of others in putting together in a very open and transparent way this architecture for Glasgow, because the private sector, ministers, regulators, governments are trying to figure out, okay, if we're trying to orient the financial system so that it doesn't matter whether it's Brookfield or it's an individual investor, it's a bank, it doesn't matter what the region they're in, that they have the information and the ways of expressing a view on climate change, how it affects a given asset, a given investment, a given trade or loan, then we've succeeded. Then we have truly mainstreamed it. So it's a lot of the UN work has been to, again, as you said earlier, we have a shared objective around net zero. The way we're saying it for the UN or for Glasgow is, okay, in the private sector, what do we need in order to make these judgments around climate change? Whether something's on the right or wrong side of climate history, whether there's value there, is value creating or value destroying in the transition. What kind of disclosure do we need? What are the technologies we need in terms of stress testing, climate VARs, other attributes? How should we talk to our investors and the public about how well we're positioned? Is it more than net zero plans? Is it specific carbon reduction objectives? Is it implied temperature warming of our portfolio, which is an emerging financial technology that I think is still a few years away from being mainstream for across portfolios, but will likely become mainstream because it's intuitive in the end. It's intuitive in terms of the position, and then also markets, what markets are missing, whether it's blended finance into emerging and developing economies or voluntary carbon offset markets, what needs to be put in place. And that's I know it's a long answer to your policy question, but that's really where that's the intersection right now that I'm operating on in terms of policy.
I do wonder on that point around policy too, that you also understand clearly, having sat in a very important seat, how you have to manage any number of crises, some anticipated, some anticipated. You mentioned that this time last year, there was some measure of agreement around the climate crisis, and then a global pandemic, comes in, and as you say, underscores some of the elements of climate, but it also is distracting to some extent. So how do you, again, given your experience, suggest that we as business people, but also as policymakers, sort of do the things all together?
That's a great question. And it's easier. It's a great question. It's easier to answer when you're not in the seat, having to do all the things together. But let me give a little gratuitous advice to those in the policymaking seats. And it's stuff they know. I think the first thing is some of the best times to prepare for a crisis. It's better to prepare for a crisis. Prepare for a crisis. Now, the crisis you prepare for is not the crisis that's going to end up happening. I mean, there's the famous Eisenhower line about plans are useless, but planning is essential, and that's absolutely right. So we had spent a great deal of time in the UK planning for a no-deal Brexit. What would happen if we had an overnight no-deal Brexit, and what could happen to the financial sector, and what protections do we need to put in place? And so we had put in place a number of those protections, which happened to mean that when you had this unforeseen crisis, the COVID shock, the buffers, the resilience, the ability to continue to transact and actually to be part of the solution of the UK financial system was enormous, and it paid dividends. So the first thing is prepare in advance, and then in the crisis, obviously you've got to execute, but it's better to have options. The second is that it's really important that coming out of a crisis, that an economy has direction, and that people have confidence in the rebuild and the regeneration of the economy. So it's not just about redistribution post-crisis, but it's about regeneration. And so pointing the direction, particularly in this case, we're fortunate. I mean, it's absolutely necessary, but we're also fortunate, and we have this opportunity to build towards sustainability, which is hugely capital intensive at a time we need a lot of investment. Now with the technologies, it's much more job heavy than traditional so-called bricks and mortar infrastructure. Wasn't always the case, is the case now. And so it's actually what we need as we get over, we're all going to have this initial pop in terms of activity once we're let out of our lovely rooms here. Everybody watching, there's going to be that pop in activity, but we need the carry through, and the carry through is going to come from investment for the future economy. So that's an essential component of where we need to go.
Sounds like a variation on the old Rahm Emanuel saw, don't waste a good crisis, right? I mean,
Well,
it sees the opportunity to some extent.
If I may, it's a variation on that, although it's a bit bigger. And, my colleague, my successor, who was my colleague, Andrew Bailey, said a couple of months ago that, they started planning for Bretton Woods. Bretton Woods was before the end of the Second World War. So they started planning the post-war architecture before the end. And his point was the Bank of England with respect to climate that's why we, the Bank of England, are going to do a climate stress test in the summer of this year. COVID may not be fully over, but we've got a plan for where the system needs to be so that you move out smartly to it. And I think that's a very wise approach. So it's a variation. It's a variation on that. I think it's a bit more in regard to the follow through with the architecture.
And do you sense, I mean, this is going back to something we talked a little bit about earlier, but from a policymaking and from a political perspective, again, and I'm going to play off of the shift here in the United States. I mean, your co-author on a paper around this is now the Secretary of the Treasury. We had the President of the United States, the new President of the United States, say, I'm back in on Paris. How meaningful is that in terms of the stature of the United States, whatever people may think of it? I mean, clearly holds sway in the world. How important is that to the broader movement?
Oh, it's hugely important. There was a lot of momentum in the broader movement towards addressing this issue, and there was huge momentum in the U.S. private sector. A lot of the innovations, a lot of most innovative companies, highest impact companies, U.S. private sector, most innovative financial institutions, U.S. private sector. So the U.S. was playing a big role. U.S. cities were playing a big role as well. But without question, having the U.S. government, the full force of the U.S. government behind this, they'll bring new ideas, better ideas, energy, the impact in terms of direct policy. And I think it's enormous. And I wouldn't underplay it at all. And I think as well, the depth of the team and the expertise of the team, Secretary Yellen, who's deeply steeped in these issues, as with many others, a true polymath, but Brian Deese, Jake Sullivan, John Kerry, all the way through, that level of understanding is critical. But recall as well, if I may, that we also have, prior to the election, we had China, South Korea, and Japan all commit to net zero themselves. And those are three global giants that are there and are focused, and actually, again, in many respects, will bring are already bringing some of the key technologies. Brookfield's one of the largest private purchasers of solar. And have unique relationships in China for solar, which we then redeploy because that technology is so good, and we can help deliver the climate solutions we need. So it's encouraging the breadth of commitment, I guess I would say.
And so you did a nice job describing, after I clumsily did it, the value that you bring to Brookfield. I would imagine, too, even though it's over Zoom and not sort of wandering down the hall, at a time of, shall we say, turmoil in the global markets, questions about inflation, questions about stimulus. I mean, if I were Bruce Flatt, I'd be Zooming you and saying, all right, what's going on in the world? I mean, what do you make of the markets that we've seen? I would be committing journalistic delinquency if I didn't ask a former central banker what he made of the world right now.
Well, let's start with the macro, and I'll try and stick as close to that as possible. We're in a situation where there's an enormous, financial sector. The core of the financial sector is in good shape. Balance sheets are in good shape. There's a tremendous amount of stimulus that is being provided. Financial conditions are very loose, shall we say, very easy. There's huge fiscal stimulus in place and more to come. And then there's this commitment of the major central banks, more explicit in one case, but softer in others, but still there, to really hold back until it's clear that inflation is sustainably at, or if not above, targets, and it's certainly above target in the case of the U.S. So all of that's lining up. The market is bringing that forward. I think and that's all given the circumstance we are in, and given the importance of taking a risk management approach, falling back into recession after what we've been through would be exceptionally difficult. Making sure the economy has traction as we come out is paramount. So its policy is poised in the right direction. Look, there are risks, though, to financial stability. There are certainly pockets of excess, and authorities need to be vigilant to those. And investors, individuals need to be vigilant to them as well, because excesses eventually are purged, and you're in better stead in the end if you're aligned to the broader structural trends, including the one we've been focused on today.
And as we wrap up, I always like to make sure that an author gets a chance to talk about his upcoming book. You've got a book that is very relevant, I believe, to this entire conversation, because it speaks a lot about, and obviously, keep me honest here, about it is called Values, and it is about both value and values, which do seem to be coming together. And we've talked a lot about the nexus of different things and intersections here. It feels like it's an appropriate intersection in many ways when we're talking about this current crisis of climate.
Yeah, it's good of you to bring it up. I mean, one of the things I did with my lockdown and my 6 months of so-called gardening leave from the Bank of England was to write the book and really to take a step back. I kind of entered as a central banker in crisis at the start of the financial crisis. I exited as a central banker in crisis at the start of the COVID crisis. I'd like to say that, those were received crises. Neither was my fault, but, I'm not sure the correlation is a little unhealthy. On reflection, there were elements of this relationship between value, how things are valued in markets and in society, and the values of society. And we don't have time to go through all of the elements of it, but certainly an excess focus on markets and market valuations and almost market fundamentalism was part of the cause of the financial crisis. I think what we get with COVID is some revealed values of society. I mean, people have cared about their neighbors, and they've done things in the interests of others, people they don't meet, even if they themselves are relatively low personal risk. And so a great sacrifice, lots of volunteering, lots of others, a sense of solidarity, community responsibility. And also what we see from that, and this is where we go to climate, is that if you shift for the big issues, whether it's health, COVID, or in the case of climate sustainability, if you shift from trading off or viewing everything as a trade-off of economy versus sustainability, and you shift that to a hierarchy where you have, well, we're going to get to sustainability and it's going to therefore be valuable to be part of the solution. Hey, you take an existential risk, which unfortunately that is what climate change is, and you turn it into arguably the biggest commercial opportunity of our time, which is why we're so focused on being part of it.
So you're having fun?
I am.
This new job?
I am having fun. And you've mentioned Bruce a couple of times, and yes, he's on the phone a lot, but that's good. He's on. I don't know how he does all the calls he does in a day, but that's part of what you got to do to manage these bigger tectonic shifts and manage the day to day. Look, I've been very fortunate, Jason, in my career, in that I've had a series of responsibilities where I've had multiple responsibilities, working across monetary policy, the macro down to the micro on bank regulations, working on climate and others, and being in these roles where I still could do that is a privilege. And final point, in the end, I'm in a role. I like being in roles where you can be measured, and we're going to be measured on, are we getting the returns to our investors, and are we accomplishing the impact? Are we catalyzing the decarbonization that the world needs alongside?